In this video, we will discuss Chapter 7, which is Accounting and Time Value of Money. Chapter 7 introduces the time value of money, or TVM, and initiates several computations involving the time value of money. Companies use time value of money in capital budgeting to assess financing needs and determine pension obligations. Chapter 7 also will discuss the fundamental concepts, the concepts such as present and future value, annuities, and annuities due will be discussed in this video. Not only does the principles of time value analysis include retirement or pension, but TVM also include loan payment schedules and decisions to invest or not to invest in new equipment. In fact, all of the concepts used in finance, none is more important than the time value of money. The learning objectives of this chapter are: 1, explain the time value of money concept, including the calculations of simple and compound interest, define the effective interest rate. 2, compute solutions to future value and present value of single sum problems. 3, compute solutions to future value of ordinary annuity and annuity due problems. 4, compute solutions to present value of ordinary annuity and annuity due problems. 5, compute solutions to future value and present value of deferred annuity problems. And 6, apply time value of money concepts to accounting applications involving determining the present value of expected cash flows and valuing bonds. So the first objective, explain the time value of money concept, including the calculations of simple and compound interest, define the effective interest rate. The time value of money concept means that a dollar received today is worth more than a dollar received at some time in the future. So what do we mean by that? That means that if you received a dollar today and you invest it, you're going to receive a return in the future. Here's an example. Suppose you invest $1,000 in a savings account today, and the savings account yields 2% annually. Then you will have not only $1,000, but you will have $1,020 by the end of the year from today. So that $20 earned on the initial investment is your interest, the cost of the use of money. The time value of money concept is critical in several areas of accounting, particularly when valuing many of the assets and liabilities reported in the financial statements. For example, measuring assets and liabilities at fair value may require time value of money computations. Time value of money concepts determine the asset's value today based on the future cash flows it will generate. To illustrate, consider a company that leases equipment to a customer. In return, the customer pays the company periodic cash payments in the future for the use of the leased equipment. The value of the lease receivable today can be measured using the future cash flows the company will receive and time value of money concepts. The same approach applies to determining the fair value of a liability. For example, a pension liability today can be measured using time value of money concepts and the future cash flows a company promises to make to its employees when they retire. The future cash flows depend on many estimates and assumptions, such as when the employee will retire, how long the employee will live after retirement, and the inflation rate. The measurements of many financial statement items, such as leases, pensions, and bonds payable, are based on estimates of future cash flows and time value of money computations. As you see here in Exhibit 7.1, it illustrates several financial statement items and the types of future cash flows used to measure them. For example, in this exhibit, you have notes receivable. So the type of future cash flows, a company makes a loan today and receives periodic interest payments and a principal payment at the note maturity. Warranty liability. A company sells some products and promises to maintain, repair, or replace the products, which represent estimated future cash flows, outflows. Leases obligation. A company receives the use of a product or property and promises to make periodic payments to the party from whom it obtained the use of the product or property. We begin our discussion of the time value of money by distinguishing between the two types of interest, simple and compound. But what exactly is interest? Interest is referred to the rent paid for the use of money for some period of time. However, in dollar terms, it is the amount of money paid or received in excess of the amount of money borrowed or lent. Interest could also be expressed as a rate at which money will grow. The term simple interest means that interest is computed only on the principal, which is that initial amount, and is not computed on any interest earned and left on deposit. Thus, simple interest is the initial investment multiplied by the stated interest rate for a single period and the amount of time, meaning in terms of the number of periods the investment is held. So the formula for simple interest is simple interest equal principal times interest rate times time. Interest rate equal P times rate times time. Here in this example of simple interest, you have a problem. Solitude Company borrows $60,000 for 3 years with a stated annual rate of 5%. So what is the interest expense incurred by Solitude, assuming that interest is computed as a simple interest? So according to the formula that we used in the previous slide, we know that simple interest is equal to principal times the rate times the time. So we came to $9,000 would be the interest. And the way we got the 9,000 is that the principal is $60,000 times the rate, which is 5%, times the years, which is time, is 3. So Solitude will pay $3,000 per year in interest for a total of $9,000 at the end of the loan term. The company will pay $3,000 per year in interest for a total of $9,000 at the end of the loan term, which is 3 years. Now, interest computed on both the principal and the interest left on deposit is referred to as a compound interest. Any interest earned is then immediately included in the computation of the next period's interest. The compounding period can be any time period, such as a quarter or even a day. So basically, when interest is earned on the interest earned in prior periods, we call it compound interest. You'll see in the next slide, Exhibit 7.2, it provides a graphical depiction of compound interest. Say that you invest $100 today for 10 years at an annual interest rate of 10%. Today, starting at year 0, you have $100. After the first year, you have the original $100 plus an additional $10. So that's the $100 times the 10% of the interest. So now you have $110 on deposit. However, during the second year, that $110 also earns 10% interest. Now it's $11. So that's $110 times 10%. So at this point, your deposit is valued at $121. That's the $100 plus the $10 plus the $11. Now, this pattern continues until the 10th year, when you have a total of $259, which consists of your original deposit or the principal of $100 plus $100 of interest earned on the principal. That is that $100 times the 10% times 10 years. And you have the $59 of interest earned on the interest left on deposit. Now, if this investment only earns simple interest, your total value at the end of the 10th year would be $200. That is, interest would be earned only on the principal. Remember, at the beginning, the principal was only $100. So that on a simple interest, it would be $100 times the 10% times the year, which is 10 years. And not on the interest left on deposit. Therefore, compounding interest increases your return by $59 and increases your effective interest rate. Here in Exhibit 7.2, you see that Solitude borrowed $60,000 for 3 years at a 5% interest rate with interest compounded annually. So Solitude will repay the entire amount, that's the principal plus the interest, at the end of the 3-year period. Thus, it is not paying any interest until the end of the 3-year. How much interest will it pay? Compare this amount of interest to the amount computed in 7.1 using the simple interest computation. Okay, so again, we see that we compute the interest incurred in the first year, which is $3,000. That's 60,000 times the 5%, because the rate is 5%. Then we would add this amount to the principal to compute the next period interest of $3,150, which is the 63,000 times the 5%. That's how you get the $3,150. Then we would add this amount to the principal plus interest balance at the beginning of the period to get a principal plus interest balance of $66,150 at the end of the second period. The interest in the third period is then $3,308. And you got that by multiplying the balance at the end of the second period, which is $66,150 times the 5%, resulting in a principal plus interest balance at the end of 3 years, which is $69,458. So you'll see an example on how that is actually done here in this slide. Assuming annual compounding, the total interest is equal to $9,458. That's the $3,000 plus the $3,150 plus the $3,308 for those 3 years. Now this total interest is $450 greater than the $9,000 simple interest incurred over the same 3-year period in example 7.1. So with this slide that you see, it has the compound interest, and the compound interest would be $9,458. But with the simple interest that we did in the previous slide, it was $9,000. So with the compound interest, you see that it's a difference of $458, which is more. So again, like I said, in the previous slide, 7.2, if the interest is compounded, the total amount of interest earned or paid is greater than if simple interest is used. Likewise, the more frequently the interest is compounded, the more interest is earned. If, for example, interest is compounded monthly, the computed interest is greater than if the interest is compounded annually. Now, many investments earn interest compounded daily. For example, bank accounts. Daily compounding increases the interest earned on the investment. Note that interest rates are always stated as annual amounts. When interest is compounded more than once per year, we determine the interest rate used in computations by dividing the annual rate by the number of periods. If interest is compounded more than once a year, the effective interest rate, which is the amount of interest actually earned, will be higher than the stated interest rate. And we'll see in 7.3 how to compute an effective interest rate. Okay, here's the problem. Crowded Company invested $1,000 for 1 year at a stated rate of 10%. Crowded Company invested $1,000 for 1 year at a stated rate of 10%. Interest is compounded semi-annually. What interest rate is used for the computations? And what is the effective interest rate? And here in the next slide, we'll see how it's actually solved. The interest rate used is 5%. which is the stated interest rate of 10% divided by 2, because interest is compounded semi-annually. Interest for the first half of the year is $50. And you got $50 by multiplying the 1,000 times the 5%. Interest for the second half of the year is $52.50 because you multiply $1,050 times the 5%. Thus, total interest is $102.50, resulting in an effective interest rate of 10.25%. And you got that by dividing $102.50 by $1,000. Here, the stated rate of interest is 10%, but the effective interest rate is 10.25%. If interest were compounded annually, the total interest would be equal to $100, and that's 1,000 times the 10%. In this case, the stated and the effective interest rates are the same and are equal to 10%, which is your $100 divided by $1,000. Now, this example illustrates that more frequent compounding increases the effective interest rate. The first step in most business decision models is to identify the value of cash flows to be received or paid at two different terminal time periods. The cash flow values at these two terminal time periods are the present value and the future value. Now, the present value is the value today of a cash flow or a series of cash flows to be received or paid in the future. The future value is the value at some specified point in the future of a cash flow or a series of cash flows to be paid or received between the current date and the specified point in the future. A business problem can involve having knowledge of either the present value or the future value and solving for the other using the interest rate and the time period. The process of moving from the present value to the future value is known as compounding. The process of moving from future value to present value is known as discounting. The time period begins at time, which is t, 0, which is 0, and ends at some future time, which is also t, which is represented in this exhibit. Exhibit point 3 presents the distinction between compounding and discounting using a timeline. So as you see, when we're moving from future value to present value, we're discounting. And moving from present value to future value, we're compounding. In analyzing the time value of money, there are two types of cash flows to identify. You have your single cash flows and annuities. An annuity is a series of periodic payments or receipts of equal amounts that occur at equal time intervals between each cash flow. Annuity payments can occur at the beginning or at the end of a period. When payments take place at the beginning of the period, the series of cash flows is called an annuity due date, or an annuity in advance. An example that we're going to use here is rent. Rent is an example of a payment made at the beginning of a period. If the payments occur at the end of the period, the series of periodic payments is known as an ordinary annuity or an annuity in arrears. Interest paid at the end of the month on a bank deposit is an illustration of an ordinary annuity. And here we are at the end of Objective 1. Explain the difference between simple and compound interest. So we know that simple interest means that interest is computed only on the principal and is not computed on any interest earned and left on deposit. Interest computed on both the principal and the interest left on deposit is referred to as compound interest. And that's the end of Objective 1. Objective 2, we will discuss compute solutions to future value and present value of single sum problems. Compute solutions to future value and present value of single sum problems.